Hello there, this is Bruce at Fleet Capital Management. It's Friday afternoon, the first day of March 2024. I have a number of things that I want to go over with you. I'm going to do my best to keep this short, but there's a lot going on that I want you to know about. We always need to start by saying the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. You know that I'm always available, Bruce at Fleet Capital Management. This is the home page of our website, fleetcapitalmanagement.com. This lower button will take you to the most recent videos. The upper button will put you on my calendar. So let's start with a little bit of seasonality. This is interesting. During the current secular long-term bull market that began in 2013, the S&P 500 has different characteristics between the first half of a quarter and the second half of a quarter, which is kind of interesting, this study that was done. And we're only talking about the first, second, and third quarter of the year, not the fourth quarter of the year. So just the first, second, and third quarter of the year. And what's interesting is during the first half of a calendar quarter, the market has averaged 18.14%. The second half of a calendar quarter, in quarters 1 through 3, has had a negative 3.37%. And these are annualized returns, of course. So what that suggests is, and in a couple of videos back, I talked to you about how we had some winds at our back that should help us throughout 2024. I talked about interest rates will start being cut probably sometime in the summer, and an election year is generally a very positive year for the S&P. And I gave you a number of reasons that we may see good returns in 2024. But within that time frame, there are other seasonal issues or timing issues that tend to reoccur, and this is one of them. So we are now in the second half of the first quarter. We're well into it because we're now in the final month, final third. But we're in this period. So I want you to put a pin in this and kind of remember this as I go along, because I'm going to show you some other things. One of the other things that I want to show you is the Fear and Greed Index, which I've shown you from time to time throughout the years. Right now, we're in this was printed today. We're in the extreme greed section. We're not as far over as I've seen us before, but we are in extreme greed. Now, I'm always looking for a confluence of factors. So one factor is it's getting a little greedy. Another factor is we're in a time of the year, second half, first quarter, where we generally have some negative returns. And then I'm going to show you something else when we get to the chart. So just kind of keep that in the back of your mind. Why do I trust my analysis rather than listen to the experts on TV? Well, I saw this and I absolutely couldn't help myself. I apologize, but this is Bitcoin. And at this moment, they actually have the minute on January 22nd of 2024. This is when Jim Cramer said Bitcoin is unlikely to find its footing. And I have to give him credit. He nailed it at the absolute bottom, but he thought it was going to continue to fall. And this is why I do research and I don't listen to people on TV. Sorry, I couldn't help myself. ETF analysis is significantly different than stock analysis. I have begun to show you the process and the research that I go through to help pick stocks. It all starts with fundamental analysis, and we have about 8,000 stocks that we can trade in the US. And through my research and fundamental analysis and scanners, I can normally bring that down from 8,000 to about 18 to 20 stocks, and I can do that pretty quickly every day. Then I take, and those 18 to 20 stocks have passed every single hurdle I've put in front of them as far as fundamental analysis. So we know that 18 out of 18 are great stocks when it comes to fundamental analysis. Then I take those and I put them on my charts and I look at the technical analysis. The technical analysis is more the when to buy, when to sell. And after I go through all of that and I check some other things, then a stock will get into our portfolio. But when it comes to ETFs, the analysis that we do is very, very different. And I'm going to talk to you about ETF analysis a lot today. So what this is this is the SPY, or the S&P 500. This card in the middle is VIG, which is the Vanguard Dividend Appreciation Fund that a lot of clients, a lot of accounts had, and you may or may not have noticed that I sold that. Excuse me, I believe it was yesterday. And then this is the symbol for something that we're probably going to be moving this money into. So let me show you how we start to look at this. We always start with the SPY because that's the S&P 500. And basically, what are we looking for? What's the goal? Well, generally speaking, we would like to make as much money as we possibly can, consistent with reducing risk, a level of risk that is comfortable for us. And I have your accounts broken down into different risk groups. But for the whole, for everyone, I think that that's true. We'd like to get as much return as we can for the least amount of risk. The question is, how do you do that? How do you do that? Because I was always told if you have lower risk, you're going to get lower returns. If you higher returns means you have to take higher risks. That's classical market analysis baloney, which is taught everywhere. Every university, it's taught everywhere. It's kind of the backbone of this industry. And for the most part, it's just not true. So what I have found to be true is that if you have risk or volatility and return, rate of return, they are two sides of the same coin, but they're not equal. What happens is if you lower your risk and don't raise your return, over time, you will end up with more money. I've been saying this now for almost 40 years. And I'm going to show this to you in some statistics. I'm also going to tell you that Warren Buffett is so genius for saying so many things, but one of the things he said is rule number one is lower your risk. And rule number two is don't forget rule number one. Okay, so here's the S&P 500. This will all make sense in just a couple of minutes. So where it says mean, this means expected mean rate of return, average rate of return. And this is just an analysis. This one right here, this is not that important, but it takes basically what has been the return over the last 3 years, and it combines the risk of the market and the risk of the security and everything else, and it comes with a mean, just to give you kind of a guide. So the mean of the S&P 500 is 12.55% rate of return. The mean of that for the VIG is lower. It's 11.35, but still very good. And then I'm going to show you a final card over here, and I'll just point out that the mean is significantly higher, okay? Don't worry about standard deviation right now, although standard deviation is a measurement of volatility. I would say of risk. Risk is volatility. It can go both ways. It can go up and it can go down, but we've got measures to look at that. Let's focus on the Sharpe ratio. The Sharpe ratio is very simply, we mathematically can look at any investment and break it down into, let's call a risk bucket, to where we know what each unit of risk is, okay? I don't want to go any deeper than that. What the Sharpe ratio is how much return are you being awarded for each unit of risk that you take? Okay, so in the Sharpe ratio, it's looking at the risk of the investment and how much the return of the investment is. And the higher the number, the better, because you want to be paid as much money as you can for each unit of risk that your investment is taking. So for this SPY, it's 0.53. For the VIG, it's 0.52. Those are virtually the same. For this last card that I'm going to go over in a few minutes, it's significantly higher. It's 0.84. So this investment over here is paying you more money for each unit of risk that you assume. That's what Sharpe ratio is. Trainer ratio, instead of looking at the investment's risk, it's looking at the market's risk. And the higher the number, the better, meaning how much are you being compensated for even being in the market, for the market risk. And don't worry about the actual number. What you want to know is higher is better. And the trainer number over on this other investment is almost twice what it is on VIG, which is the investment I just sold, the ETF, and the SPY. Okay. Then we go down to information ratio. I don't think I'm going to spend a lot of time on this, but this is a way that we can judge the manager of the investment, and how consistent are their returns. You might have two investments, both that have blockbuster returns, but then when we apply the information ratio, what we're looking for is, did one manager have one great year and just knock the ball out of the park? And then the other manager maybe has been successful year after year after year. So it's a way to critique the manager, actually. And all you need to know is higher is better. And on this third panel, this is much higher. Beta, not terribly important, but beta is the risk of the market. So the market will always have a beta of 1. The VIG had a beta about 14% less than the overall market, and this card over here about 12% less than the overall market. Not a very important statistic, but it's there anyway. Alpha is an important statistic. And again, bear with me. I know this is new, and this will all come together in a minute. Alpha is how much return is the investment giving you where it exceeds the return of the index of the S&P 500. So even though this is a negative, don't worry about that. That's because of their internal fee is 7 basis points. But the alpha of the S&P 500 is basically 0. It is the market, okay? It can't give you more than the market because it is the market. The alpha on VIG is 0.12. So it's giving you slightly more return over time than the S&P 500, slightly. And the alpha on this third card is 6.34, which is dramatically more, okay? We're not going to worry about R squared. Last thing on here, and then I'm going to take you to charts, and that's when this will all come together. Up-down capture ratio. This is really 100 and 100. It's off by a couple of basis points or pennies, but that's because of their internal fee. When the market goes up, how much of the market return does the SPY capture? Well, it is the market, so it captures 100% of the upside. And when the markets are going down, how much of the downside does it capture? Well, it captures 100% because it is the market. So if the S&P is up 10%, the SPY will be up 10%. If the S&P is down 10%, the SPY will be down 10%. It is the market. The goal with upside downside capture ratio is you want to capture in your investing as much of the upside as you possibly can, and you want to avoid in the downside as much as you possibly can. So that's the goal. If we look at VIG, VIG was only capturing about 86 or 87% of the upside, but it was capturing 85% of the downside. So this is almost as if it were 100% and 100%, because it's just a little less on the up, a little less on the down, and they kind of match or correlate. If you look at this third card over here, this one is capturing 102% of the upside. So if the S&P is up 100%, then this investment would be up 102%. But here's the interesting thing, the downside capture. In the quarters where the market is down, it's only capturing about 78% of the downside. So that's really significant. I'm going to show this to you on charts, and it's all going to make sense. But what I want to show you is there are statistical, mathematical ways that we can compare any number of ETFs, and this is the way we do it. But what we really haven't talked about yet is how does all this analysis play out in performance, okay? I'm going to get back to that in just a second. So that's your introduction into analysis for ETFs, but it'll make sense in a minute. Now, I always say the single most important thing to know is whether the market's going up or down. Everything follows from there. Let's start here with our matrix, updated today, of course, and you can see that we are green across the board. Our daily group 1, which is most aggressive, is all green. Group 2, a little bit more conservative, all green. Our daily moving averages are all perfect, our bear market avoidance, this is our primary and secondary, is perfect. The VIX is at 13.12. It's actually come down again for the second week in a row. And remember our rule. If the VIX is below 20, that is bullish. If it's above 20, that is bearish. And I won't confuse you, but I will say that that number really should be about 18. But this is a very bullish number. And then this new metric that I've added, the IBD exposure, is still at 4. It's been at 4 for a bit of time. 4 and 5 is green. And what they mean by that is that if it's a 4, you should have 60 to 80% of your money invested in the markets for that portion of your risk tolerance. So they're still at 60 to 80%. Nothing has changed there. Let's go over to, and before we get to the markets, let's get over to how do those statistics play out in terms of money. So SPX is the S&P 500. That's the only thing I have on this chart so far. I've got the S&P 500, and the time frame that I'm looking at, let me just move something here, is 2022. So obviously that was a bear market. The S&P 500 was down 19.44%. So we're in 2022. First, we're going to look at downside, then we'll look at upside. And now I'm going to put VIG on the chart to see, and that is in red. Hopefully you can see that. VIG during that down year, because VIG does take a little bit less risk, you can see lost less money than the overall market. The S&P was down 19.44. VIG was down 11.62. So you might say, okay, so far VIG is a better investment if you're trying to lower risk. And I would say you're right. You are at least half right. So we'll get to that. So that was 2022. How did it do? How's this comparison do in 2023, which was a very positive year? Let me move this again. Bear with me. There we go. Okay, so now we're looking at 2023, and what you can see is VIG in the red was up 8% for 2023. The S&P was up 18.9%. So, okay, what can we now decide? Well, VIG, we expect it. Now, this is classical analysis. We expect it to perform less because it's lower risk. Okay, so it did a little bit better in down markets. It grossly underperformed in up markets. Let's do one more thing and say, well, how did that comparison look if we look at one down year, one up year? We're going to look at 2022 and 2023. And what you will see is they ended up pretty much the same, So is that a good investment? Well, you buy VIG so that it will reduce your downside during down markets. This is 2022, and it did that. But you also want to make as much money as you can in up markets. It didn't do that. So now let's overlay one more thing. Let's go back to making this just 2022. And I'm going to put that third investment, which is a newer investment for you, up on the chart. So we're looking at 2022, bear market, okay? This blue line is the S&P 500, was down 19.4. The red line is VIG, it was down 11.63. And this other investment that I'm introducing you to was down 2.44. So this other investment did exceptionally well, much better than VIG, which is Vanguard Dividend Appreciation Fund, in protecting money in a bear market. It was only down 2.5, where the others were down significantly more. Okay, but how does it do in up markets? Well, let's go to 2023. And here is 2023, and VIG is on the bottom. VIG did this. Am I in 2023? Yes. And the other investment did exceptionally well. Excuse me, I'm sorry. Let me scroll that out just a little bit so I can get to the end. There we go. Okay, so the S&P, which is in blue, was up 34.1%, and this other investment was up 48%. Okay, so now let's think for a second. This investment that I'm talking about lost the least amount in 2022. It made significantly more in 2023. Well, the last part that I look at is, well, how did it do over combined 2022 and 2023? And here's where the rubber meets the road. And everything we've talked about prior to this is this is the bullet point of it. Here is VIG and the S&P 500 over that 2-year span. And here is this new investment that I'm introducing you to over the same 2-year span. So remember I said that the goal is minimize your downside as much as you can when the market's going down. But when the market's going up, maximize your upside. Well, that's what this has done. So we have a bear market year and a bull market year, and this other investment has shown significantly more able to dampen the downside and make money on the upside. Okay, so I hope that makes sense. I kind of went through it quick, but I am doing this type of analysis. Let me go back to the analysis with pretty much everything on the ETF side that we own or we are considering. I'm only showing you this one because yesterday I sold VIG and I sold it, and then on Monday I'm going to replace it with this other investment because we're getting paid significantly more. That's the Sharpe ratio for each unit of risk. We're getting paid significantly more than the market. We have a fabulous consistency information ratio. We're getting a lot of alpha, excess performance over the S&P 500, and we're doing it while taking even less risk on the downside than the Vanguard dividend. Forget the upside for a second. We're taking less risk, and that's a significant difference, than even this conservative Vanguard dividend appreciation. So that's what I wanted to show you, is there are ways to slice and dice mathematically and through statistical analysis to see if we can find investments that will give us what we want, which is our cake, and we want to eat it too. We want it to help dampen any downside when the markets are going down, and we want it to really do well on the upside when the markets are going up. So that's what I wanted to show you on that. And this is that 2 years. And I can even go right up until today. Let's go to 2024. And we are now March 1st. And there you go. So the S&P for that particular time frame is up 7.78. And this investment's up 34.61. So I'm going to be adding this to a number of accounts. Everyone who I sold VIG for, every account that I sold that yesterday on Monday is going to start to get this. And then I'm doing a lot more analysis on our other ETFs. And when I'm finished with that, I will bring that information to you. So now let's go to our main charts. But before we get to the S&P, I want to show you Massimo. MASI is a stock that we were in, and we wrote it up very nicely. And it had earnings the other day. It was on February 27th after the market closed. And because of some weakness that I was seeing, I actually put a stop in the system. I kind of wish I didn't, but I'm okay that I did, because what happened was the day before the earnings, the price closed at 129.83. It opened the next morning. This is called a gap. It opened way down here at 124.19, and then it continued down through our stop. We got stopped out, and then it closed right in here. Okay, so I kind of wish we hadn't gotten stopped out, but now that I'm seeing even what's going on technically, I'm okay with it, because with that massive move, if you can see here, the white is the 8-day moving average. It's just below the 20-day moving average. That's not a good sign. I don't want to see that. Another thing is this red DI, which is directional index, has now crossed above the green. I don't want to see that. We are below the midline of the relative strength index, which is RSI. Don't want to see that. And this down here is called on balance volume, or OBV. There are more sell orders than buy orders, or there's more sell volume than buy volume. So here's the thing. I kind of wished that we weren't stopped out, because then it closed back in a normal range. But then now that I've seen the technicals, I'm pretty happy actually that we're out of it. And I don't know, because we live over here in the dark area, I don't know how much lower that might go, or it just might be doing a little shakeout. It can go sideways. Remember, the market can go up, down, or sideways. That's it. Looks to me like it might be building a new base. If it builds a base and then the technicals start to turn back up, I'm probably going to rebuy this stock, because I think this stock has more upside to go for us. We've made money, but I think we're going to make more. But I'm not going to jump the gun. I'm going to wait until the technicals tell me that we should get back into it. But I wanted to show you this because a lot of times I don't put a stop in the system. This is one of the times I did, and then I wished I didn't, but actually now I'm fine with it because of how it's all looking. So I wanted to show that to you. So let's end with, let's go to the S&P 500. And remember that I told you that this period of the quarter, second half of the quarter, is a negative annualized period of time, or at least it's nowhere near as good as the first half of the quarter. And that happens in quarters 1, 2, and 3. It does not happen in quarter 4. So I told you that. And then I also showed you that the fear index is a little bit high. Well, here's the S&P 500 on a daily chart. And I've got to be honest, everything looks fine. It just looks absolutely fine on the daily chart. Here was another piece of information that got me thinking. Let me go to the weekly chart. So here's the weekly chart of the S&P 500, which means each one of these bars represents 1 week, 5 trading days. A couple things to notice. Number one, we just closed today a little bit outside of the linear regression. That tends to suggest we could come back into the linear regression. That's number one. Number two, look at the angle of this rise. We normally like to see bottom left to top right. That would be a 45-degree angle. If I were to grab something like this, a 45-degree angle from here might be something like that, okay? That looks kind of like a 45-degree angle. This looks nothing. Whoops. Sorry about that. This looks nothing like a 45-degree angle. I'm not sure what the angle is. I can probably measure it, but that's almost straight up. That we call that parabolic. That's too fast. It's just too fast. When things like that happen, they normally settle back down. So why am I telling you all this? I'm telling you all of this if we take the seasonality, which we're in a difficult time for the next month, if we take the fear and greed, if we take this parabolic rise over the last couple of months, that suggests to me that we may see some weakness coming ahead. I wouldn't be surprised if we saw a little bit of weakness over this next month. I don't know if it's going to happen, but that's what it suggests to me. And the reason I went through this whole thing, let's make sure, is we've been stopped out of a couple of stocks, and I'm not in a rush to get that money back into the stock market. If I see something that's just knocking my socks off, yeah, I'll probably buy it. But we can take our time. And why am I doing this analysis on the ETFs? Because I anticipate, I don't predict, I anticipate that we could see a little bit of weakness. That wouldn't be surprising at all. And if I can move us into an investment that is dampening the downside, but we'll still be ready to spring forth when we go back to the upside, that would be wonderful for all of us. So Lot of information I just went over with you. You can always watch the video again. You can pause it. You can call me. We can talk about it. But because of that confluence of factors, A, I'm not as aggressively putting money back to work for the next few weeks in the market. And B, that's why I'm doing the analysis on the ETFs with more to come, because I want to make sure that we are in the very best position as we that we can possibly be in, to take advantage of the upside that will come, more upside, I believe, for this year, but also position ourselves so we are cushioned to a certain degree against downside. So, um, always pay attention to risk is rule number one. And rule number two is never forget rule number one. And that's what we do. And that's why it's working. If you have any questions at all whatsoever, I'm always available. If you enjoy the video, this type of content, I know I went deeper. Feel free to hit a thumbs up on the YouTube or shoot me an email. Let me know. If it's way too much information, let me know that as well, and I'll tailor it back down. So have a wonderful weekend. I'm here. If you have any questions, let me know, and we will talk about this further. Anyway, talk to you soon. Bye-bye.